Welcome back. Today, we're diving into 5 lesser-known stocks that have been generating buzz above food ingredients, ABE, Stakeholder Foods, STKH, Sequans Communication, SQNS, Q32 Bio, QTTB, and Dallas News Corporation, DALN. We'll break down what each company does, look at their financials, and decide if any are hidden gems or value traps. I'll give you my honest take: buy, hold, or pass. The goal: cut through the hype and focus on fundamentals. If you like deep dive stock analysis, hit that like button and subscribe for more. Let's jump in. First up, let's talk about Above Food Ingredients, ticker symbol ABVE, a company that's making waves as a vertically integrated player in the ever-evolving plant-based food space. Above Food isn't just another brand on the shelf. They're aiming to reshape how plant-based proteins are grown, processed, and delivered to your table. What sets ABVE apart is their control over the entire supply chain, from the very first seed planted in the field to the final product on the grocery store shelf. They're not just sourcing ingredients, they're growing them, processing them, and turning them into a wide range of plant-based proteins and specialty ingredients. Their main crops: oats, lentils, and chickpeas, staples in the plant-based world, and all grown with a focus on sustainability and traceability. This farm-to-shelf model gives Above Food a real edge. By managing every step, they can ensure higher quality standards, respond quickly to market trends, and potentially keep costs lower than competitors who rely on third-party suppliers. Plus, they're not just selling to consumers, they're also a key supplier to other food businesses, which diversifies their revenue streams and helps them weather market ups and downs. But let's be real, the plant-based trend is booming, and that means competition is intense. Heavyweights like Beyond Meat, Oatly, and even global food giants like Nestle are all fighting for shelf space and consumer attention. The market is crowded, and standing out requires constant innovation, strong branding, and the ability to scale quickly. ABV's vertical integration could be a powerful moat, protecting them from some of the supply chain headaches that plague competitors. But it's a double-edged sword. By owning the whole process, they're also exposed to risks like poor harvests, climate change impacts, and wild swings in commodity prices. If crops fail or input costs spike, it hits their bottom line directly. Financially, Above Food is in growth mode. Their revenues are climbing as they expand their product lines and distribution, but that growth comes at a cost. They're burning through cash at a rapid pace, investing heavily in infrastructure, R&D, and marketing. To keep the lights on, they've been raising capital, which means issuing new shares and diluting existing shareholders, a red flag for some investors. The big question is whether they can flip the switch from spending to sustainable profit before their financial runway runs out. It's a classic race against time. Can they scale up, capture enough market share, and improve margins before needing another cash infusion? Investors are watching closely to see if management can execute on their ambitious plans. The market has noticed the risks. ABV's stock has been on a roller coaster, with sharp ups and downs reflecting investor uncertainty about their path to profitability. Volatility is the name of the game here, and it's not for the faint of heart. For me, this is a speculative play. I'd need to see clear signs of improving margins, a slowdown in cash burn, and a credible plan to reach profitability before I'd consider buying in. Until then, it's a high-risk, high-reward story that requires careful monitoring. Right now, ABVE is firmly on my watch list. It's an intriguing company with a compelling vision, but the risks are just too high for new money at this stage. I'll be keeping an eye on their financials and execution, waiting for signs of a real turnaround. If you're already invested and believe in the long-term vision, holding might make sense, but be prepared for a bumpy ride. For most investors, though, patience and caution are key. Sometimes the best move is to wait and see how the story develops. There are plenty of safer places to park your cash while this plant-based story unfolds. For now, Above Food Ingredients is a company to watch, not to chase. Next, let's talk about Stakeholder Foods, ticker symbol STKH, a company that's truly pushing the boundaries of what's possible in the world of food technology. They're at the forefront of a revolution, using 3D printing and cultivated animal cells to create meat that doesn't require raising or slaughtering animals. Imagine biting into a steak that was never part of a cow, but is still made of real animal cells with the same texture, flavor, and nutritional value as traditional meat. The process starts with a small sample of animal cells, which are then grown in a nutrient-rich environment. These cells multiply and are carefully layered using advanced 3D bioprinters, building up the structure of a steak, chicken breast, or even fish fillet, layer by layer. This isn't plant-based meat or a soy substitute, it's real meat, just made in a lab instead of on a farm. The potential impact of this technology is enormous. Not only could it dramatically reduce the need for factory farming, which is a major source of greenhouse gas emissions, water use, and animal suffering, but it could also help feed a growing global population more sustainably. If successful, 3D printed meat could disrupt the entire meat industry, offering a more ethical and environmentally friendly alternative to conventional meat production. But let's be clear, the hurdles are massive. The technology behind cultivated meat is still in its infancy, and producing it at scale is extremely expensive. The cost of bioreactors, growth media, and specialized equipment is high, and scaling up from lab experiments to mass production is a huge challenge. On top of that, regulatory approval is a long, uncertain process. Governments around the world are still figuring out how to classify and regulate lab-grown meat, and it could be years before these products are widely available on supermarket shelves. There's no guarantee that approval will come quickly, or at all. Right now, Stakeholder Foods is pre-revenue. They're burning through cash to fund research and development, and their future depends entirely on making major scientific breakthroughs. If they can't solve the technical and regulatory challenges, the company could run out of money before ever bringing a product to market. Investing in a company like this is a lot like venture capital. You're not buying into a proven business with steady cash flow, you're betting on a scientific leap that may or may not happen. The upside is huge, but so is the risk. The risk of total loss is very real. The stock is extremely volatile, and while the potential rewards are massive, they're also extremely unlikely to materialize in the near term. Most investors should be prepared for the possibility that their investment could go to zero. For most people, this is not a stock to buy and hold for retirement. It's a moonshot, a high-risk, high-reward gamble that's more suited to a small speculative part of your portfolio than your core savings. If you're tempted to speculate, do so with money you can afford to lose. Think of it like buying a lottery ticket. The odds are long, but the payoff could be life-changing if everything goes right. Personally, I'm fascinated by the technology and the possibilities it represents. The idea of creating real meat without the ethical and environmental downsides of traditional farming is incredibly exciting. But as an investment, it's just too early for me to justify putting money in right now. For now, I'll be watching from the sidelines, keeping an eye on the major milestones. If Stakeholder Foods can prove the technology works at scale and clear regulatory hurdles, it could be a game changer. Until then, it's a fascinating story to follow, but not a bet I'm willing to make just yet. Let's dive into the story of Sequans Communication, or SQNS, a French technology company that's quietly playing a crucial role in the rapidly expanding world of the Internet of Things, or IoT. Based in France, Sequans specializes in designing advanced chips that help connect everyday objects to the Internet, making our world smarter and more efficient. While you might not see their name on consumer gadgets, their technology is embedded in the infrastructure that powers the connected devices all around us. Sequans chips are the brains behind a wide range of IoT applications, from smart meters that monitor your home's energy usage, to asset trackers that keep tabs on valuable shipments, to connected vehicles that communicate with each other and the road. Their technology is everywhere. They also enable smart home devices, industrial sensors, and even medical equipment, helping to create a seamless web of connectivity that's transforming industries and daily life. The IoT market is experiencing explosive growth, with billions of devices coming online every year. The rollout of fifth generation, or 5G networks is accelerating this trend, providing the high-speed, low-latency connections that IoT devices need to operate efficiently. As more companies and consumers adopt smart technology, the demand for reliable, energy-efficient chips like those made by Sequans continues to rise. Sequans operates as a fabless semiconductor company, which means they focus on designing and developing their chips in-house, while outsourcing the actual manufacturing to specialized foundries. This business model allows them to concentrate on innovation and research and development, staying nimble in a fast-changing industry. Their engineers are constantly working to push the boundaries of what's possible in wireless communication and IoT connectivity. Within their niche, Sequans has earned a reputation for delivering solutions that balance low power consumption with high reliability. Their chips are used in everything from rugged industrial sensors that operate in harsh environments, to delicate medical devices that require absolute precision. This versatility has helped them carve out a respected position in the competitive IoT landscape. However, the semiconductor industry is notoriously tough. Giants like Qualcomm, Intel, and MediaTek dominate the market, making it difficult for smaller players like Sequans to compete on scale and resources. The pace of innovation is relentless, and companies must constantly invest in new technology just to keep up. As a result, Sequans has faced ongoing challenges with profitability and maintaining steady growth. Their stock price has reflected this volatility, swinging up and down as the company navigates industry headwinds and competitive pressures. Investors have had to weather significant uncertainty, with the company's future often in question. Recently, the landscape shifted dramatically when Renesas Electronics, a major Japanese semiconductor company, announced its intention to acquire Sequans. This move is set to reshape the company's future, bringing Sequans technology under the umbrella of a much larger and more resource-rich organization. For investors, the story has changed. The focus is now on merger arbitrage, essentially betting that the acquisition will go through at the agreed-upon price. This strategy involves analyzing the likelihood of the deal closing and trying to profit from the small difference between Sequans' current stock price and the acquisition offer. The potential upside for investors is now limited to that narrow gap, while the risk is significant if the deal falls apart for any reason. Regulatory hurdles, financing issues, or unexpected developments could all derail the acquisition, leaving shareholders exposed to sharp losses. For those who were interested in Sequans as a long-term play on the growth of the Internet of Things, that opportunity has essentially ended. The company's future is now tied to the outcome of this acquisition, making it a short-term, event-driven investment rather than a bet on IoT innovation. Unless you're an experienced arbitrage specialist comfortable with the risks of merger deals, this is probably a stock to avoid for now. The IoT revolution will continue, but for Sequans, the story is entering a new chapter, one that's all about deal-making, not disruptive technology. Q32 Bio, QTTB, is a clinical-stage biotech focused on autoimmune and inflammatory diseases. Their lead drug targets conditions like eczema and alopecia areata, big markets if successful. But biotech is high risk. Most drugs fail in trials, and Q32 has no products or revenue yet. They recently merged with Homology Medicines, gaining cash and a public listing. This gives them a longer runway to fund trials, but the core risk remains. Success hinges on positive clinical data. Investing here is a binary bet. Great results could send the stock soaring, but failure could wipe it out. Unless you have deep expertise in biotech and the science behind their drugs, this is pure speculation. For most, a diversified biotech ETF is a safer way to play the sector. My verdict, Q32. Bio is a pass for my portfolio, too risky, too binary. Last up, Dallas News Corporation DALN, parent of the Dallas Morning News. This is a legacy media company fighting to survive in a digital world. Print advertising and circulation are shrinking fast. Digital subscriptions and marketing are the new hope. They've launched a digital marketing agency, Medium Giant, to diversify revenue. Financially, it's tough. Declining revenue, cost-cutting, and a constant struggle to grow digital faster than print declines. Sometimes these companies look cheap due to valuable real estate or low price-to-book ratios, attracting value investors. But a low valuation can be a value trap if the business keeps shrinking. DALN is profitable and pays a dividend, but the industry headwinds are fierce. Betting on a turnaround here means believing management can outpace the decline and build a sustainable digital business. Personally, I avoid industries in structural decline. Too much effort for too little reward. My verdict, DALN is a pass. The risks outweigh the potential upside. Quick recap, ABVE is a wait-and-see, STKH is a hard pass, SQNS is now a merger arbitrage play, QTTB is a speculative biotech bet, DALN is a potential value trap. Remember, this is just my analysis, not financial advice. Always do your own research. Look at the numbers, understand the risks, and decide what fits your goals. I'd love to hear your thoughts. Do you own any of these? Disagree with my take? Drop a comment below. If you have other stocks you want analyzed, let me know in the comments. Thanks for watching. If you found this helpful, hit subscribe and I'll see you in the next video.